Now we're moving on to hear from Sean Kidney. Sean is the co-founder and CEO of the Climate Bonds Initiative, which is based in London. And he's working to mobilize global capital to finance a rapid global transition to a low carbon and climate resilient economy. And Sean, welcome to today's program. Glad you could join us.
Hey, Paul, thanks for having me. And thanks, Peter, for continuing to host this conference year in, year out. This persistence will pay. Look, I'm here to talk about green bonds.
Let's talk about
social bonds.
Go ahead.
so
We've got Paul, a 1.6 trillion market underway here.
Well, exactly. Can you believe it? 1.6 trillion. Now, admittedly, the US economy is 17 trillion, but from nothing a few years ago, we now have the fastest growing market on the planet. So it's cool. And this year, we're going to see another 400 to 500 billion added to the pile. And because the European Commission has said they're going to issue $250 million a year, it's going to get larger next year. So, you know, it's growing and growing and growing. You know, the capital we've got to invest in making this transition. We've got a long way to go. It's a good start, but actually we've got to invest 90 trillion between now and 2030, which is a huge amount of money to shift our societies to become low carbon and climate resilient. The good news is we have the capital. We have more than enough capital floating around in low interest and zero interest rate bonds and places like that. And it wants green. So the point about the green bond market is not the green bonds themselves, it's the extent of investor interest. You know, when the Italians put out their green sovereign bond only a few weeks ago, they got 10 times the number of orders for the 8.5 billion they placed. And this is a story we see again and again and again. We could probably place 10 trillion tomorrow if we had them. It's a beautiful market, glorious, because the supply is the problem. We have demand in space. We just don't have enough of these things. Of course, the reason why we're doing this, the reason why it's happening, is we've crafted an instrument that is simple. It's essentially debt with a similar risk yield profile compared to ordinary bonds, and investors can put them in the portfolio now and address a long-term risk that they have started worrying about, which is climate change, climate impacts, and how their portfolios are going to suffer with the volatility that we now know will be the norm. I mean, boy, we've seen volatility in the last year, haven't we? This pandemic, people may not realize, has its roots in climate change. The IPCC, Intergovernmental Panel on Climate Change, has been saying for 30 years, we will see pandemics becoming a feature of climate change as environments are disrupted. In this case, it was about pathogens jumping between species as a result of degraded environments in Southeast Asia and Southern China. And this is what happens again and again. You get pandemics. We've had them in the 1600s. We had them in Roman times when we had climate change. We're going to get them again. We're in a race now to try and keep climate change to vaguely manageable level, not catastrophic, to avoid extreme pandemics and the volatility that goes with all the things that happen, like wildfires in California as well. And investors understand this. Long-term investors that have got actuaries that actually read long-term tables and read the science absolutely get this stuff. The challenge is now getting investments to them that will make a difference. Now, they're not going to take a 1%, a 2%, or a 10% cut because they're paying your pension, Paul, or my pension. So they've got some fiduciary responsibilities, but they are taking a haircut. We now see across the board in EUR and USD savings of about 5 to 7 to 30 basis points, depending on the credit rating, if you issue a green bond compared to a vanilla bond. So it's there, it's happening. And now it's just a matter of getting everyone aware of it and getting moving. So that's the story. Of course, we've had a big fillip in the last week. I mean, over the last 18 months, since before the pandemic, we've seen 110 countries around the world commit to net zero targets. Not a bad start. There were about 18 months ago. Now, in the lead up to the Biden summit, we saw the European Union confirm its 2050 or 2030 target, We saw Biden confirm the US's 2030 target, and then we saw 2030 targets from a range of other countries like Japan and Canada and so on. So this is actually a really important stepping up. None of them know how they're going to do it yet. None of them. All they know is they've got to get their skates on, and they're looking at it. Now, in the Biden administration is doing a lot of initial work around everything from air pollution to support for renewables to transport. But, you know, time is short, as we know. The first administration is the administration to make or break us when it comes to climate, the first Biden administration. In other words, the next 3.5 years is when we'll know whether we're going to make serious progress on climate change or not. But it is looking damn good now, and I'm expecting a humongous amount of green bonds. Just to be clear, green bonds are a means, they're not the end. The end is governments acting. You know, if we've got green bonds out, it is easier, but it does, to fund a high-speed rail between Boston and Washington, D.C., which God knows we need to get those planes out of the air. But it still requires strong government action to sort out the thicket of municipal and state legislation that is stopping that being built. So, you know, I don't want to get away from the fact that governments have to act. But when they do act, we can fund this with private capital and with green bonds. And that's the opportunity, Paul.
Sean, as you're mentioning, and so far the focus of your remarks has been on the US and the new regulatory environment that we have developing here under the Biden administration, which I think all of us on the call today are excited about and looking forward to further developments. It's different in Europe, right? They're ahead of us on that curve. They're acting more on legislation in the near term and bringing the regulatory environment up to speed in a different way. Tell us what you see related to the two different regulatory and major regulatory environments right now. What are the differences and how are they similar?
Well, the European Commission has made a very strong commitment to greening the economy now. The Recovery and Resilience Plan, the equivalent of Biden's recovery plan that was passed in Congress recently, is meant to be 1/3 allocated purely to green investments. And for the other 2/3, member states, the equivalent of states in the US, have to show how what they're doing will support increased resilience in the economy and in society. This is a recognition that pandemics may come again, and we need to prepare for a future of volatility. So for a start, that's pretty amazing. Secondly, we've seen regulation passed to support the transition. For example, the TCFD recommendations, the Task Force on Climate Finance-Related Disclosure, chaired by Michael Bloomberg, have morphed in the European Union into what's called a sustainable finance disclosure regulation, where you have to not only show your high carbon investments, but also your sustainable investments. Now, with the positive side of the ledger, all corporations, banks, and investors will be required in future to disclose against that. If you roll out a green or a sustainable product, you can't just make it up yourself, whether it's sustainable. It has to fit a new regulation, which is the taxonomy regulation, which is a shopping list of green investments for the future. So if you're not on the list, actually you're not green. And guess what? Unabated gas is not on the list. Because at the end of the day, we now know that the footprint of emissions from gas-fired power is actually huge. There are some LNG plants in Australia, where I am at the moment for another week, that have a greenhouse gas footprint the same as a coal-fired power station when you take into account the fugitive emissions. And nowhere, especially in the States, have we been calculating properly the fugitive emissions of a greenhouse gas that is 84 times more potent than CO2. So this has been recognized now in the European Commission. The taxonomy has gone through, and there are a whole lot of other legislative arrangements going through in what's called an action plan for sustainable finance, including rules about fiduciary disclosure, discussion about long-term investments and directors needing to be responsible for these sort of things. There's a bunch of things happening. I have to say it's exciting. I've been on these expert committees for 5 years. And when we first wrote our report to the Commission in 2016, end of 2016, we had no idea how much they would pick up the baton and run with it. And they have been. It's like exciting to watch. So there's a toolkit here. But let me say, it's not just the European Union that's got interesting toolkits, although the European Union is more advanced than the US, I think, at this stage. But, there's stuff happening in China. We've been blinded by the culture wars the last couple of years. China is an economy trying to turn. The center of the government is trying to shift the provinces. And they have fights all the time, just like Washington has fights with the states in the US. Recently, the National Energy Agency, who's been approving coal-fired power stations last year in the middle of the stimulus boom, was hauled over the coals by the state cabinet, by the national government, for having, guess what, approved coal-fired power stations. And this inquiry run by the national cabinet recommended that a whole lot of coal-fired power stations that were in construction be pulled apart and dismantled. And then it said, coup de grace in China, that the leaders of the National Energy Agency had failed to follow Xi Jinping thought. It's pretty amazing. Now, that gives you a clue to what Xi Jinping thought is. It's all about clean green. They're trying to figure out how fast they can change their economy. They will beat their targets by a country mile because the central government's trying to change. And the People's Bank of China, the central bank, the US Fed equivalent, does things like, if you're a provincial bank and you post green bonds as collateral at the liquidity lending window, you get a 1% discount on wholesale capital. Now, wouldn't Jamie Dimon like that? And wouldn't that be a powerful incentive to boost green bonds in the US? They're trialing a whole lot of things like that. So we're very excited about their progress too. But hey, it's a low bar. They've got a lot to change. As Peter pointed out earlier, it's still a dirty economy. But then, the US isn't exactly clean and squeaky clean at this stage too. So we've got a lot of work to do.
So Sean, I know you're going to enjoy this question from our audience. How can investors deploy capital in the green bond market today?
Well, we are seeing a lot of issuance from all over the place. And if you're an institutional investor, you can get access to it. If you're an individual investor or small investor, you can get access to ETFs. For example, Van Eck in New York has a green bond ETF. There are more and more of these coming into play. You'll see a few announcements in coming months. There's a whole world of small-scale municipal green bonds as well. So keep an eye out for those. They're coming out of play everywhere from New York to California to even Arkansas recently for water investments. So they're available too with tax credits, hopefully, as the infrastructure plan tackles this kind of issue. So, there's actually quite a bit around, but you know what? Your broker probably doesn't know about it because they are not switched on. Ask them, hunt around, because it's definitely there. If you go to our website, you can see a list of every single green bond ever issued. And so you can poke around and ask your broker, how do I get hold of some of this stuff? It is there, but look, 1.1 trillion green bonds, 1.6 trillion overall sustainable bonds is still small compared to the global $100 trillion market. So it's not like buying ice cream in the supermarket just yet, but hopefully we'll get there in the next couple of years.
Here's another question from our audience, Sean, related to the regulatory comments, regulatory environment comments that you were making. Currently, there are no penalties for firms missing their green targets or misallocation of their use of proceeds in the green bond market. Are there developments in the market for greater protection for investors over time?
Well, this has become an issue as we see smaller and smaller issuers. But at the moment, green bonds are big issuers. So you tend to get $500 million or $1 billion, and $100 million bonds are relatively small, unless you're in the muni space where there's a whole market supervision involved in it. If you mess up your green bond, and I remember the treasurer of the first green bond issue in Hong Kong said to me that after he issued his bond, his investors took him to lunch and they said, we really like what you've done with the green bond, but you realize if you don't deliver on what you promised to do, we're going to screw you. You understand that, don't you? And that's how bond markets work. You know, reputation is everything. You mess up a bond, you're not going to get another bond away, or at least not for another 5 years. So there is a self-policing aspect, which is working beautifully so far. It doesn't mean we don't have disputes with some bond issuers, but at least they're being transparent and clear. In fact, the only scam that we've seen in the green bond market was globally, was in Syracuse, New York, when in 2009, a property developer got a green bond tax credit out of a piece of legislation. Only 2 tax credits were issued to retrofit a shopping center. And he decided, as he had a reputation for doing, I'm not going to bother doing that. An investigator in the Syracuse Journal found out about this, wrote a story about it. The IRS investigated it eventually, and then found that the legislation had been crafted. So we didn't need to do it. He just needed to promise it. Go figure. We need to get a legislation right. But in the meantime, at this stage of the market, we have really tough policing by investors who are watching these things with an eagle eye. And we as an NGO watch them too. So it's pretty good. The penalties is not the issue at the moment. What we're beginning to see in governments like in China and also in Europe, where incentives started to come in, is then you get regulatory oversight. So this is what will happen in the US too the next few years. As incentives come in, we expect the SEC to start taking a tough line on it as the market grows and we get more risk of scams. So not a problem yet. Keep an eye out on this space.
Okay. Now let's go back to the municipal market, which, as you know, Sean, is a huge market here in the US. And there's gradual growth in the green bond issuance within the municipal market. Are the qualifications for those bonds or use of proceeds any different than they are in the corporate markets or the sovereign markets?
No, same principle. I mean, take, for example, in New York, where Peter is at the moment, New York MTA is the largest issuer of green bonds in the municipal market in the States. They've even advertised in the subway line for them, and they keep putting them out. What is it? Low carbon transport. Why is low carbon transport important? Because we desperately need a modal shift out of petrol-based cars and trucks onto electric transport. So it's a fantastic program, but also New York State Housing has been issuing bonds for energy efficient public housing. The BART system in San Francisco is a regular green bond issuer. I mentioned Arkansas Water. There's a bunch of water producers like San Francisco Public Utilities or Washington DC Water who've issued green bonds. So there's a lot going on, bubbling away, so to speak. Quite a lot of these are using climate bond certification, which is essentially the gold standard. But, you know, we're more concerned the money goes to the right place. If they don't use the certification, that's fine by us. We'll check out their bond and kick the tires anyway and review them. And so far, we're doing pretty well in the States, I have to say, in terms of the quality of the issuance. They work just like a corporate use of proceeds bond.
Terrific. Now, Sean, we've got a couple of minutes left in this segment of our program today. So what's next in the green bond market?
Next is making it easy to know what's green. If we want to make this market grow, we've got issuers have to understand all the opportunities here. For example, Peter mentioned mining before. Dead right, because we need to do a massive amount of green economy development. That is going to involve mining that is strategically important for the shift to the low carbon economy. Copper, cobalt, lithium, and things like that. There's a wide range of areas, from agri to transport to buildings to energy to manufacturing, zero carbon steel, and so on. So there's a lot that needs to be understood, but the boundaries are important. So take an example. If GM were to build a diesel plant outside of Detroit, and they'd be reducing the emissions 15% of that diesel plant, sounds good, right? Wrong, because the reduction in emissions we have to get out of the transport sector are much steeper than diesel will allow. They've got to leapfrog to electric. And if they build a diesel plant, they're going to block the chance to go electric. So that'd be counterproductive. Luckily, GM is going electric. So all so far good. But in every sector, we've got to understand what have we got to do to really achieve the Paris Agreement. Is it ambitious enough, Or is it too pale green, too little livid? And that's the challenge. And so in Europe and in China, we've done green definitions. Europe announced it on the 21st of April, just before the Biden summit. China, on the same day, deliberately announced the upgrade of its green definitions catalogue. Europe and China are working to harmonise, to create common ground, and we're inviting Washington, DC to join in that program to do a global approach. Now, the reason that's important is once you commoditize what's in and what's out, every man can play, every woman can play. Step one. Step two, preference everything. Like the way we built bridges or built railways over the last 150 years is we've said, you can do that, you can't do that. And if you do this, we'll give you guarantees or a discount or a tax credit or something. That's all we have to do here. It's not particularly complicated. And we can build trillions if we get the settings right, as we are beginning now to experiment with in China and in Europe, and hopefully under this administration in the US. That was shifting. But I want to leave you with one last thought, Paul.
Sure.
You know, we're having a trade war between China, Europe, and the US. It's electorally popular. It's not going to go away. But one thing we can do is carve out a green window of collaboration. Think of it as zero tariffs for zero carbon steel, or preferential rates for green investment products. This is something we could negotiate between the major economies, and it would turbocharge the transition. This is the year to do it.
Great. Sean, thank you so much for your comments today. We really appreciate you joining us from London. And we look forward to hearing much more about the Climate Bond Initiative as this market grows and the regulatory environment unfolds.